I love reading articles where the person talks about great dividend stocks that are yielding higher than, your average dividend stock, that are more suited for early retirement or retirement in general. And I came across this article here on Seeking Alpha from Roberts Berzin, and the article is titled "Hard to Imagine a Retirement Portfolio Without These 5 High Yield Gems." I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. And there's a lot of things that I like about this article, especially if you're looking for new ideas and different stocks or ETFs that you may want to consider in retirement. I think this is going to be an article for you. But I will say I wouldn't go and just, invest into these stocks just because you read an article or watched a video like this. But I think this will give you a good insight into the type of investments that you should be considering. And these will then be on your radar. So that's what I really like about articles like this, is maybe stocks or ETFs that you didn't have on your radar before. Articles like this are great to get those stocks and ETFs on your radar. So let's take a look at the article here. And the summary he has here, that retirement income investing at its core is about not touching the principal and enjoying high and durable dividends. Well, it sounds simple. It actually requires a careful and diligent security selection process. The key is to find a balance between high yield or risk and safety. In this article, I elaborate on 5 income-driven picks, which in my view should be placed at the core of a retirement portfolio. When investing for retirement, unless one has alternative sources of current income, it usually makes sense to focus on durable and high-yielding securities. The idea is to maximize the amount of pocketed cash income per each dollar invested in the portfolio without the following 2 things. So the first thing to avoid is using the starting principal that could increase the risk of outliving the income. So this is kind of like the 4% rule, where you're selling your portfolio to live off of your portfolio. This is different than dividend investing, where you're just living off of the income that your portfolio produces. The second, experiencing dividend cuts that could potentially require you to decrease living expenses, or in the worst case, shift some part of the portfolio into higher yielding and riskier stocks to bounce back to the pre-dividend cut income level. Dividend investing comes with some emotional advantages as well. For example, for those who are close or already in retirement period, the notion of not having to rely on security sales to fund retirement decreases the mental stress of worrying about the right time to harvest portions of the asset base. This is kind of what's called the sequence of returns risk when you are selling a portion of your portfolio to live off each year. Investors who are still in active accumulation phase can also benefit from being subject to an inherently more stable investment progress, which is predicated on steadily growing the portfolio's cash income streams quarter by quarter. With that being said, there is still some due diligence that has to be put in. What we do not want is to fall into value traps chasing high yields with an attempt to reach on our investment goals sooner. Instead, we have to be very selective and really combine the 2 aspects together: yield maximization from one side and yield sustainability from the other side. On top of this, we have to capitalize on what is offered for free, for example, diversification. Finally, to avoid inflation eroding the overall purchasing power of the retirement income portfolio, it is a must to incorporate at least some assets that provide not only high and sustainable yields, but also an element of stable income growth. Now, this is so important, guys. I'm really glad that he mentioned this, because what you don't want to do is just go and invest all into high yielding ETFs or stocks and just totally disregard the growth, because inflation is real. It is that silent killer. And if you have a long-term time horizon, say you retire in your 50s, you could still live another 30, 40 plus years. And so you want your income and your quality of life to continue to grow as you age. So that's really important. And I'm glad that he mentioned that, because most people, they just focus on one or the other. But in my opinion, they are equally as important. Without further ado, here are some of my favorite picks from each of my favorite yield-driven asset classes, which in my humble opinion could easily be put at the core of a retirement income portfolio. So the first pick is Realty Income. Realty Income, or ticker O, is my second largest position in the portfolio. It is also one of the largest equity REITs out there with a market cap of just over 50 billion, which itself is a meaningful benefit from the diversification and business risk mitigation perspective. Currently, Realty Income offers a monthly dividend yield of 5.5%, which is a rather tangible level, especially in the context of the underlying fundamental strengths here. For example, Realty Income is one of the few REITs that has obtained an upper investment credit rating, which allows them to keep the cost of capital as low as possible. This is in conjunction with Realty Income's conservative funds from operation payout ratio of 75%, which offers a very solid base for management to expand the portfolio further in a financially sustainable manner. The underlying borrowing structure is also well laddered, thereby decreasing the current key risk that many REITs face, for example, rising long-term yields. In a nutshell, I would definitely include Realty Income in a retirement portfolio as an asset which offers reliable and steady growth dividends stemming from the real estate segment. So I really like what he talks about here. Talks about the credit rating, the quality aspect of investing into Realty Income. The only thing that I'm a little bit skeptical of, if you follow my channel, is having this be your largest position. I don't know what percentage this makes up of his portfolio, but in my opinion, no single stock. If you follow my channel and you follow the core and satellite, which I talk about on my channel, I don't believe that any single stock should be considered a core position, because no single stock, in my opinion, should represent more than 5% of your overall portfolio, and therefore it would then by default just be a satellite position. So in my opinion, this is across the board. I don't think that it would be wise for your average person to have a core holding in a single stock more than 5%. And so for me, it just wouldn't be a core holding at a 5% weighting. And so you put two and two together, no single stock could be a core position, just in terms of how you view it, right? And it may be a little bit nitpicky, but I think it's important to have rules when you invest and guidelines that you can follow. And that's one that I follow. And if you're a long-term subscriber of the channel, you've heard me say this a million times, but it is so, so important. Pick number 2 is Enbridge. Enbridge, ticker ENB, is my largest position in the midstream infrastructure segment, which fits nicely into durable income-seeking portfolios. Just as Realty Income, ENB is one of the biggest players in its field, currently carrying almost 95 billion in market cap. What is also similar to Realty Income is that ENB has paid consistent dividends for decades, and considering the state of the fundamentals, the probabilities for an unexpected dividend cut are truly distant. The essence here lies in ENB's business model, where the majority of the cash flows are linked to service-based agreements. These agreements are usually stipulated with bankable off-takers and come with embedded rent or inflation-linked revenue escalators. What I like about ENB is its growth-oriented management, which has, as of Q3 of 2024, outlined a CapEx pipeline of 21 billion, since ENB has an investment-grade balance sheet and leverage within the range of 4.5 to 5 times. There's a solid basis in place to accommodate growth without assuming excessive financial risk. Another source for facilitating growth stems from the growing EBITDA generation, which in turn is derived from both embedded top-line escalators and the previously funded projects coming online. For example, management estimates that near-term EBITDA growth by 2026 to land between 7 to 9% per year. All of this offers a solid case for defensive income investors to lock in a growing 6% dividend. So I don't know much about Enbridge. It's not a stock that I invest in. I've looked at it in the past, but the business model with the pipeline or the midstream, I'm just not that familiar with it. It's not something that I personally have invested in. I'd have to do a little bit more research on it, but I know that, the fundamentals are good. Every article that I read that talks about it always talks about it positively. So if you're in that range where you're looking to retire in the near term and you're looking for some single stock exposure and you want a higher than average yield, like a 6% yield. So it may be one to consider. Pick number 3 is Main Street Capital. Main Street Capital, ticker MAIN, is arguably the most conservative BDC, so business development company, which still provides a fairly decent yield of 8%. For some, it might come as a surprise that Main is recommended as one of the core positions in a retirement portfolio. The theoretical risks are related to Main's business segment that is about providing expensive loan financing to private companies which cannot access cheap traditional bank loans or IG bond markets. So yet, if we peel back the onion a bit, we will quickly realize that Main is rather unique and inherently defensive. There are 3 critical aspects I would like to highlight in this context. The first is the lion's share of Main's debt lies in the first lien space, which is the safest zone to provide financing in the BDC sector, plus the weighted average senior leverage of portfolio investment stands at 2.8 times EBITDA, which means that Main is definitely in the top decile when it comes to portfolio quality defensiveness. Second, Main has one of the lowest leverage ratios in the BDC sector. As of Q3 of this year, the debt to equity stood at 0.86 times. This provides ample financing capacity to capitalize on recovering M&A markets, which is critical for generating incremental cash flows, for example, to grow the portfolio and capture more spreads. And then third, Main has more than $6 per share in cumulative pre-tax net unrealized appreciation. To put it simply, Main has the optionality to over time monetize these equity gains of underlying portfolio investments that would result in a strong boost to the cash flow generation. If all of this gets monetized, Main could theoretically cover its dividend for 1.5 years just from these extraordinary cash flows alone. So finally, we have to appreciate the fact that Main has never reduced its monthly base dividend already 17 years in a row. All in all, I would feel comfortable including Main in a retirement-focused portfolio to enhance the overall yield level without speculative risk taking. Yet Main is I think always been considered a high quality BDC. I've never seen an article that's talked poorly about BDC. The only time that I see any negative comments or articles about Main Street Capital is when it gets overvalued relative to its historical norm. But the track record is really impressive. You'd have to read up on BDCs if there's any different tax treatment, how that works. But yeah, I mean, all in all, as a company, I think if you wanted to have it as a small satellite position, I wouldn't see anything wrong with any of these so far that we've touched on in the article. So pick number 4 is the one and only JEPQ, one of my largest actually this is my largest holding in my portfolio because it has grown so much over these last couple of years. But yeah, JEPQ. So let's take a look at. Well, the previous securities nicely cover the value-driven segments. The JP Morgan Equity Premium Income ETF, JEPQ, offers quite unique dividend factor that could be inserted in a high-income portfolio. The mechanism of how JEPQ generates value is through a cover call strategy. It means that JEPQ sells call options against the underlying index while they do equity linked notes. So it's a little bit different than other cover call ETFs. JEPQ focuses on ELNs. And so they pocket tangible premiums. These premiums are then distributed back to unit holders together with the dividends collected from the NASDAQ 100 exposure. It is the key reason why the historical average dividend yield has been around 9 to 10%. It currently yields at 9.3%. The key drawback here is that the cover call strategy limits the upside potential that could be driven by surging index value. Yet as long as the investment strategy is based on collecting high income streams, it should not be an issue that in some years JEPQ does not register alpha. This year, the NASDAQ has been on a tear and JEPQ has been on a tear. It's done very, very well in a bear market. JEPQ generally will do the best, in my opinion, in a flat market. In a flat market and also in a bear market, it does well. The only downside is in a raging bull market where as he mentioned here, the upside is capped. So the bottom line is that by investing in a JEPQ, investors can enhance the overall portfolio yield level with relatively stable income that tends to fluctuate on average between 9 and 10%. At the same time, since the calls are rarely sold at the money, they're never, from what I understand, they're never sold at the money. So not rarely, they are not. They're always sold out of the money. There is some room left for JEPQ to produce some price upside as well. And then pick number 5, the Schwab US Dividend Equity ETF, SCHD, is one of the most popular dividend growth ETFs among retail investors. It is also my favorite ETF to access the dividend growth factor. The issue with the 4 picks outlined above is that they do not offer significant dividend growth potential, especially JEPQ and Maine. With Realty Income and Enbridge, we can count on inflation level dividend growth, which is still not that attractive. To solve this, SCHD comes into play. Since SCHD's strategy is to invest in large blue chip businesses with significant dividend growth potential and track record. For instance, the 5-year dividend CAGR stands at 12%, which is obviously way above the level offered by other recommended names. Additionally, an aspect we have to factor in is that by actually deploying capital into SCHD now, there's no meaningful yield sacrifice as the current yield is at around 3.3%. So the bottom line here, the 5 investment picks that are described above could be viewed as major constituents of a high and durable retirement income portfolio. Collectively, they represent exposure from key value or dividend-driven sectors such as REITs, infrastructure, private credit, and option-driven ETFs. Although the first 4 picks produce attractive and sustainable dividends, the growth aspect is quite immaterial. To balance things out without taking notable sacrifices on the yield front, SCHD could be factored into the equation. The idea is that the presence of SCHD could allow investors to structure a portfolio that would reduce the risk of inflation destroying investors' purchasing power of their dividend streams. So that's the article. Let's take a look at a few comments. The first comment here, you're good, all 5 are good, not taking away anything from Realty Income, but I prefer NNN. For Realty Income's history and popularity, I would expect for it to sell at a higher or lower yield. Yeah, this is an interesting comment because Realty Income is a fan favorite. I think, Realty Income is one of the largest REITs out there. It is a retail REIT, covers the retail space. Whenever you go into a Walgreens or, a CVS, there's a good chance that that building is owned by Realty Income. And I think I can only speculate because, other retail REITs are doing okay. But I guess the question is how are tariffs or inflation going to potentially impact Realty Income? And I don't know. I think I kind of agree. I would assume, that what's interesting about this is if you look pre-pandemic, Realty Income had always demanded a high valuation. You don't do PE because it's a REIT, a high price to funds from operations, right? So after, the pandemic, which was mostly focused on, smaller retail, right? Realty Income has really lagged the overall market and has lagged a lot of other growth-oriented REITs. And so I don't know. I think the big advantage that Realty Income has is its scale and its diversification and credit rating. He mentioned that in the article. They can access credit and grow that way because they have a low cost of capital. So I am still very bullish on Realty Income. I love that it pays monthly. I love its track record. I love that the management is forced to focus on not taking risks because the dividend is, or the distribution is such an important part of the investment, of why shareholders own it. So the management is required to be very responsible with how they manage their finances, because if they were to ever cut their dividend, the distribution, the stock would get hammered. It's just going to get annihilated. So it is mission critical that they maintain a healthy balance sheet and that they're able to continue to grow their distribution. Otherwise, the market's just, completely hammer them. But yeah, just my 2 cents. Another comment here, I own 3 of them in my income portfolio of 40 stocks and ETFs, but I'm close to all 5. Instead of Enbridge, I own EPD, and instead of JEPQ, I own JEPI. So yeah, EPD, I mean, you look at EPD this year, and over the last 5 years, it's like at a 5-year high. It's done very, very well. In terms of JEPQ and JEPI, I wouldn't necessarily look at it as, can I only buy one or the other? I personally own both of them, and they're very different in the sense that they hold completely different index. JEPI is focused on the S&P 500 and it's focused on a low volatility index. So you're not going to get a lot of volatility. The way that I personally look at JEPI as a dividend investor who's living off of his portfolio, I look at JEPI as kind of like a bond proxy. JEPI is going to get a 7 to 8% return, whether from the dividend or the capital appreciation on an annual basis. You're not going to get much more than 8% on an annual basis. Now with JEPQ, there's a lot more alpha to be had so with JEPQ, it's not focused on a low volatility index. It's focused on the NASDAQ, and the NASDAQ there's more beta, there's more volatility. And how do you generate income from an option strategy? Well, volatility. And because they sell out of they write out of the money, or their ELNs are structured that way, you have a lot more upside potential. And so I hinted a week or so ago that I'm going to be sharing an update on my portfolio. You could probably imagine there's going to be a lot more JEPQ and JEPI in my portfolio. And so just to kind of throw that out there as a little teaser for when I make that video, when I share an update on my portfolio. But those are the little bit of, the differences in terms of JEPI and JEPQ. And if you were to ask, well, which one is better? They're similar and different. And in my opinion, I would own both of them. And that's exactly what I do. I own both of them. So that's the article. I would give the article a B+. The article does what you would expect. It highlights 5 investment options that you could consider in retirement, but he does a good job at outlining the importance of yield today and yield tomorrow with a balance of growth and income. That's what I like the most about this article, is not just focusing on, just looking at one side of this. It's so important that you have a balance of both and that you're looking at this on a weighted average basis. Okay. So when you're calculating your portfolio, you want to look at the weighted average dividend yield of your portfolio, and you want to look at the weighted average dividend growth of your portfolio. There's weighted average calculators online. I would recommend using them for your portfolio. Now, if you have 30 or 40 individual stocks, that's going to be a little bit difficult, not impossible, but a little bit more work, but something to definitely consider. I think the article is very high level. He doesn't go into a lot of detail, especially with JEPQ and SHD, very, very high level, doesn't really get into the nitty gritty. And that's not what this article was really intended for. So it does what it's supposed to and what it's meant to do. And I wouldn't consider, and I mentioned this a little bit earlier, I would highly recommend, if you follow my channel and if what I say resonates with you, I would highly encourage you, don't look at it at a single stock, and don't consider a single stock part of your core portfolio. A core part of your portfolio, it should be more in index funds, right? And that's just my opinion, how I view it. But if you follow my channel and you kind of agree with my way of thinking, I hope that makes sense. And when you're looking at individual stocks, these are satellite positions. These are to add either more growth or more income, depending on your time horizon, what you're looking for. And you balance out your portfolio based off of your goals, needs, and time horizon. So yeah, thank you so much, everybody. I hope that the video was helpful, and I'll see everybody in next week's video.